Good evening, everyone.
Good evening, Mr. Moyo.
Good evening, sir.
Okay, thank you. How many are we? Okay, I think people are just coming in.
Just for now.
Okay, let's go back to our practice question. Okay, I gave you, okay, before we more or less look at the November 2018 diet question 3, let's use this opportunity to attempt question 13. Question 13 is a follow-up to question 12, which we did yesterday. And I'm trying to explain the difference between question 12 and question 13. Now I'm trying to put it together on the same screen so that we can be able to compare the two at a glance. Okay. Now question 13 reads as thus. Assuming question 12 above, but as at the end of the year 2015, that is 31st December 2015, the FRS announced a change in the tax rate to 30%, commencing from the period beginning 1st of January 2016. We are required to carry out the same operation as what we did yesterday. A, current taxes for the relevant periods. B, deferred taxes for the relevant period. C, income tax expense or credit for the relevant periods. And lastly, we shall determine the effect tax rate. Okay. The next step is for me to share the white screen, and we should tend to attempt that question. And we are going to more or less rely on what we discussed yesterday to serve as a guide to us. And some of those information will be based on what we have already done yesterday. Okay. Question 13. Today is 26th of August, 2020. Now, A says we should determine the current taxes for 2014 to 2017. 2014, 2015, 2016, and 2017. Recall, all figures are in thousand. Now we start with our accounting profits, which is our profit before taxes. Remember, it's fairly stable on an average of 400,000 naira per year. And recall, we added back our depreciation, accounting depreciation, which was straight line depreciation of 250 across the 4-year period. From there, we're able to obtain our adjusted profits, which stood at 650 across board. Now, thereafter, we deduct our capital allowance. Year 1 was 500, year 2 was 300, year 3 was 200, and year 4 was nil, because we are only granted allowance for the first 3 years based on the information made available. Then we are able to obtain our taxable profits. 150 in year 1, 350 in year 2, 450 in year 3, and 650 in year 4. Our tax rates, this is where we have that concern now. Our tax rate initially was 40%. We are given information that in 2015, the tax rate was changed from 40% to 30%, but is expected to take effect from the period beginning 1st of January 2016. The question then is, in 2014, what tax rate are we going to use? 40%. Because as of 2014, nothing has changed. In 2015, what are we to use? Though the new tax rate was pronounced in 2015, but is to take effect from 2016. Therefore, for the actual tax we are going to pay in 2015, we are still going to make use of 40%. What matters is the effective date, not the pronouncement for actual taxes. Now, it then means that in 2016, this becomes our cutoff. The position change between 2015 and 16, and our new tax rate is 30%, our staircase. And going forward, until future time when there might be possibility of change in the tax rate. Next, what is our current tax? Our current tax is for us to multiply our tax rates by taxable profits. And we need to bring out our calculators now and assist me in determining what the amount is. First year, it is 40% of 150. How much is that? How much is that? Okay.
60.
It's 60. Thank you. Year 2, 140. Year 3?
180.
How much?
180.
That's wrong.
Oh,
135. Sorry.
It's
0.3.
135.
Remember
135.
that the tax rate has changed. Please let us be careful. And the fourth year,
195.
195. Okay, as simple as ABC. Now our deferred tax. Remember, the years 2014, 2015, 2016, and 2017. We need to compare our carrying amount with our tax base. All figures in thousand. Remember, as computed yesterday, carrying amount was 750 in year 1, 500 in year 2, 250 in year 3, and 0 in year 4. While tax base was 500 in year 1, 200 in year 2, 0 in year 3, and 0 in year 4. Recall that because the carrying amount of asset is greater than the tax base, we say what we have is a temporary difference that is considered taxable. And that position has not changed. And what is our taxable temporary difference in 2014 is 250. In 2015 is 300. In 2016 is 250. And 2017 is 0. What is our tax rate? Our tax rate in 2014 was 40%, because that was the rate that exists as at that date. But in 2015, there was a pronouncement up to the end of the year that the tax rate effective from 2016 will be 30%. Now the question then is, when are we going to effect the change for deferred tax? Is it in the year it was pronounced or in the year it takes effect?
The year it takes effect.
Okay. Now, if you say the year it takes effect, I think we'll be wrong. Why? Deferred tax, by definition and by its principle, is to capture the future tax consequence. It's not the same thing as current tax. Current tax is to capture the current tax consequence, the actual tax payable on the activities and performance of that year. But deferred tax is talking about capturing what is omitted in that year that relates to future years, which then means that the consequence you are capturing is not of today, but of the future as it impacts to you. The question then is, as at the time the consequence will crystallize, it will crystallize when the tax rate is no longer 40%, but rather 30%. In that situation, it then means that we need to capture equally the effect of future change in the tax rate as pronounced by the law, which then means that unlike actual tax, the effect is on the time it actually took effect. But for deferred tax, it's more or less taking effect in advance of the effective date, because as at 31st December 2015, the amount of deferred tax that you are recognizing is in relation to what affect 2016, 17, and upward. Which then means that immediately you have to take that into consideration, which invariably means that the effect will be 30% from 2015, which means my cutoff in this case, is 2015. Now, take note, this principle of changing it in 2015 is known as the liability method. It's known as what? The liability method.
Go and wear clothes now. Why do you remove your clothes now?
Hello, can we mute? Now, the liability method, the liability method assumes that the effect of deferred tax, change in tax rates applies in the year the pronouncement was made, or because by liability, there is a present obligation which shows that as at when it crystallizes, it's going to crystallize at the rate of 30%, not at the rate of 40%. But there's alternative to that method, which is not permitted by IAS 12. We call it the deferral method, which means when there's a change in tax rates, the effect on deferred tax can be captured either by adopting liability method or deferral method. But in line with the provision of IAS 12, only the liability method is permitted, while the deferral method is not permitted. It's not allowed. Okay, which means you must take note of that. Liability method is what we use. And what does liability method say? It says you have to capture the effect of changes in tax rates in the period in which the information is made available. But a situation could exist where the impacts will be the same on actual taxes and deferred tax. When is that? Imagine the pronouncement was made in 2015 and is taking effect immediately, which means it's taking effect in that 2015, which means in that situation, both computation of current tax and deferred tax will recognize the new rate of 30% in 2015. But anytime you find a situation where the pronouncement is made in a year in advance of the effective date, for current tax, the new rate will take effect in the effective date, while for deferred tax, the new rate will take effect from the pronouncement date, which is a year ahead of the effective date. And in that simple light, we should be able to get that concept. Now, in this case, what is my deferred tax liability? Remember, when you multiply the tax rate by your taxable temporary difference, what you get is deferred tax liability. Now, to determine that, what do we do? 40% times 250 in year one, that gives us 100. Year two, 30% times 300, that gives us 90. Year three, 30% times 250, that gives us 75. And year four, 30% times 0 gives us 0. Now, as I've said earlier, I can use this singular table to quickly determine my deferred tax expense or credit. Now remember, 2014 was our first year of commencement of business or incorporation. Therefore, we had zero amount of deferred tax as our opening balance. But as at the end of the year, the balance is 100, which means it has increased from 0 to 100. And that shows recognition of deferred tax expense of 100. But between 2014 and 2015, it has decreased from 100 to 90, which means it has reduced by how much? By 10, which is a credit. Between 2015 and 2016, it has reduced from 90 to 75, which is 15. That's another credit. And between 2016 and 17, it has reduced from 75 to 0, which is credit. Okay, in that situation, I can also show you, based on the other method we use or other presentation method we use. Okay, I can still repeat it. You just need to adopt the one that best suits you. Movement in deferred tax liability. In 2014, 2015, 2016, and 2017. All figures in thousand. Now we start. Our deferred tax as at the beginning of the year, 2014 was 0. But as at the end of the year, it was 100. If you remember, let me show you. Now, invariably, what has happened? There's an increase of 100. I remember the balance in 2014 is carried forward to 2015. And in 2015, the balance is now 90, which shows what? A decrease of 10. 90 moves as the opening balance in 2016. Now it is 75. It has further decreased by 15. And that 75 is recognized in 2017 as opening balance. And as at the end of 2017, is nil, which shows a total reversal, which means to get the same thing, which means you just need to be more or less sure of the presentation method that best suits you. Invariably, we can show the C says, what is our income tax? Sorry. What is our income tax? Our income tax expense for 2014 to 2017 are as follows. 2014, 15, 16, and 17. Now, what is our current tax? As computed earlier, our current tax was 140, 180. Is that correct? Let's check. Okay, sorry. No, 60, 140. No, that's not correct. 60. 60, 140, 135, and 195. Okay, why our deferred tax was 100, credit of 10, credit of 15, and credit of 75. When we sum it all, what do we have? We have 160, 130, 120, and 120. Now, what does that signify? We'll see the effect of this by computing our effective tax rate. What is our effective tax rate? It's simply the ratio of the amount of income taxes recognized in proportion of our profits before taxes. Now, in 2014, our income tax is 160 million, as shown here. Why? Remember, our profits, accounting profit was 400, which invariably gives us that 40% approximately. In 2015, the value has changed, all because between 2015 and 2016, there is the effect slightly from the deferred tax that impacts recognition of income tax. And in that year, we have 130 as our current taxes. And what is the ratio of that? 130 as a ratio of 400. That gives us 32.5%. And in 2016 to 2017, the income tax stabilized at 120, all because the rate is now 30% across board. Therefore, 120 as a ratio of 400 million return us back to the 30%. Which then implies that 2015 is where the adjusting effect of changes in tax rate is effected prior to stabilization, which means 2015 is simply the year of change as it relates to deferred tax. As it relates to what? Deferred tax. Now, you could see that 30% is more or less equal to 30% from 2016 henceforth. Why 40% is equal to our rates up to 2014 and 2015 when it was 40%. But 2015 is what adjusts for the movement from 40% to 30%, which we more or less made based on the requirements of the methodology adopted, which is the liability method. And take note, the only method permitted by IAS 12 is the liability method. Now you've seen how changes in tax rates could affect your deferred tax computation and your current tax computation. And at your own leisure time, you can more or less compare the two solutions and also further read the material or note or your ICANN material for further understanding of the difference in solutions when there was no change in tax rate and when there is a change in tax rate. And that's why I could go back to the presentation slide where I can share the requirement of IAS 12. Now, IAS 12, the effect of changes in tax rates. Where the corporate rate of income tax fluctuates from one year to another, a problem arises, which you also evidence in the solution we just completed. And the problem arises in respect of the amount of deferred tax to be credited or debited to profit or loss in later years. The amount could be calculated using either of the two methods. The deferred method assumes that the deferred tax account is an item of deferred tax relief, which is credited to profit in the year in which the timing difference are reversed. Therefore, the tax effect of timing difference are calculated using tax rate current when the differences arise. That is the reason why the standard does not allow it. It's not necessarily capturing the future tax consequence, it's only capturing the current consequence. Likewise, the liability method assumes that the tax effect of timing difference should be regarded as an amount of tax ultimately due by or to the company. Therefore, the deferred tax provision are calculated at the year it occurs. Only a single adjustment to the opening balance of the deferred tax account is required, which is what we did. And that's why you find out that the adjustment impacted 2015. IAS 12 requires deferred assets and liabilities to be measured at the tax rate expected to apply in the period when the asset is realized or when the liability is settled, based on the tax rate and loss enacted or substantively enacted at the year end. In other words, IAS 12 requires the liability method to be adopted. And that is the same thing I've explained to us, which means at every point in time, we must take note that the only method or methodology accepted by the requirement of IAS 12 is the liability method. Any question?
Good evening, sir. Well done. Thank you for this privilege.
Yeah.
Yeah, I would like to ask, I came in late. I just saw the chat, the group chat, so I came in late. I don't know if you can share with us the materials you used to solve the questions. I know that you will still share with us the solutions, but then I'll appreciate you can get the questions so that I can also work along with it. Thank you.
The question has since been shared from day one. Okay. All the materials were shared on day one. I don't know the group you belong to. Okay, if you belong to any of the valid group, you will have seen it in the group WhatsApp messages, where I've given you the PDF, the presentation material, the question, practice question, and also past question from 2014 to 2019, including the ICANN material for financial reporting. Everything has been shared. I think probably you could speak to one or two of your colleagues to forward it to you if you are not in the group. But if you're in the group, you can access that material there. Is that okay, sir? And also, what happened is that this video, this lecture is being recorded, and the link to the video after the class will equally be shared, which means that you can equally see the question from there. Okay, thank you.
Thank you, sir.
Any other question? Okay, in the absence of no question, now let's go back to our presentation And let us talk about the impact of discounting. Let's talk about the impact of discounting in computation of deferred tax. Now, you all understand that because of the effect of time value of money in accounting and also in finance, discounting principles are applied at every instance where you have to recognize future values of an item and we need to obtain what the value is today. Having identified the future values of our cash flows, in order to obtain the value today, we need to discount them to the present. Which then means that at every point in time, we are looking into the future from today. In order to make meaning about the future, we find what is the present value of those future values. Now, the same thing is what is being considered here. Now, current taxes barely have effect of discounting because current taxes are actual taxes payable for that year, which means issue of discounting does not even come in to current taxes. Now, for deferred tax is considering the effect of future taxes or future tax consequences. The question then is the future we are talking about is not 1 year, it's not 2 years, it spans as many years as possible. Now the question then is, should we discount the temporary differences? For example, you see the question we just solved. As of 2014, we still have 2015, 2016, and 2017 ahead of us. Are we to discount the future value of our temporary difference? But what the standard says is that discounting does not apply in determining our deferred tax. There are 2 reasons for that. The first one is ideological. And what does that imply? It implies that an attempt to discount the temporary difference may be tantamount to you double discounting. What does that mean? In the recognition of some assets and liabilities, their kind amount itself is measured at present value. And present value means they've discounted the cash flows to obtain the value. Now, comparing that kind amount with the tax base again gives you temporary difference. And you now want to discount that temporary difference. It then means that you are discounting twice, which contravenes the principle of time value of money. On that basis, the board, which is the IASB, concluded that discounting should not be applied. The second reason why it's not being applied is because the complexity involved in tracking and reconciling the deferred tax movement over time may be impracticable. Impracticable in the sense that it might be onerous in doing so. In that regard, the board concluded that discounting should never be applied in computing deferred taxes, which then means that if you are given a question to speak to the facts or arguments that should discounting be applied in line with IAS 12 to the recognition of deferred tax, you have to be emphatic by stating clearly that it does not apply, and you must be able to justify the reason. Okay, and that represents the position for that. Or you have a practical question where they give you cost of capital or a discount rate or a discount factor. You ignore it in totality when you are computing deferred tax. And that is the position of the standard. Now, the other one is this. There are 3 schools of thought with respect to how deferred tax is to be recognized. The first school of thought says Of what essence or need is the recognition of deferred tax? They believe that deferred tax should not be provided for. Rather, only the current tax should be shown in the financial statement. But that argument is considered invalid because it failed to abide by the accrual principle and equally the matching concepts. Secondly, a school of thought says deferred tax should only be recognized on specific class of items, specific assets and liabilities, such as items of property, plant and equipment, and probably investment. Okay, but that school of thought also failed to realize that tax consequences are not necessarily on specific assets, but they can be attributed to the collective of assets and liabilities that generate economic benefits. And finally, the third school of thought talks about making full provision, and which is the position that is adopted by IAS 12, which says deferred tax should be recognized as far as possible on all assets and liabilities, which then means that deferred tax should always be computed on all assets and liabilities, provided it gives rise to temporary difference. And that will more or less lead us to attempting to solve the question for November Diet 2018. November Diet 2018. And let me share that question. Okay, I want somebody to read the question for us. And okay, can somebody read the question for us? Who is volunteering?
Question 3.
Yes, it's on the screen.
Yemike Nigeria Limited has an accounting profit before taxation 225 million for the year ended 31st December 2017. The following are extracts of the financial position of Yemike Nigeria Limited as of December 31, 2017. Non-current assets, building 157,500,000. Plant and machinery, assets held for sale. Receivables, we have trade receivables. We have, I can't see this clearly. Income receivables, we have, oh, okay, thank you. Okay, income receivables, we have the payables, we have fines. If you can help us increase the font again, because I'm using my phone, I'm not using my laptop. Okay, payables, we have fines. Thank you.
Okay.
We have finance obligations. We have interest payables, the values as given. The following information is relevant. Okay, the following was acquired.
The building.
Sorry. Oh, sorry. The building was acquired by the company as at the cost of 175 million at the start of the year. And it is the policy of the company to depreciate building at 10% per annum on straight line basis. The company The company, this is so tiny. The company tax contribution have stated that the company can.
The company,
if you can't see it clearly, let me read it.
Okay, let another person read it if you can see it clearly.
The company tax consultants have stated that the company can claim more than 5 million naira capital allowance this year on the building. 2, the balance in respect of plants and machinery is after providing for depreciation of 30 million naira, and the capital allowance claimable on it is 25 million naira. 3, the assets held under finance lease was acquired during the year. The relevant tax law does not distinguish between finance lease and operating lease. Rental expense for lease is tax deductible. The annual lease rental is 72 million naira and was paid on December 31st, 2017. The depreciation policy for lease asset is 20% per annum on straight line, and annual finance charge amounted to 36 million. 4, the receivable figure is shown net of an allowance for doubtful balances of 17.5 million. This is the first year that such an allowance has been recognized. A deduction for debt is only allowed for tax purposes when the debtor enters liquidation. 5, interest income is taxed and interest expense is allowable both on cash basis. There are no opening balances on interest receivables and interest payable. 6, provision for fines and penalties are not allowable deduction for tax purposes. The fines payable is a provision made during the year. Required: A, calculate current tax expense for the period. B, calculate the deferred tax liability as at December 31st, 2017. C, prepare notes showing the components of tax expense for the year.
Okay. Thank you very much. Okay, let's try and solve the question one by one. I hope you screenshot or you have already have the question, and let me change it to my whiteboard. Okay, question 3. ICANN November 2018 diet. It says we should determine the current tax expense. Now let's start with our accounting profits. In the question, we're given our accounting profits to be how much? Our accounting profit is 225 million. Now we need to carry out a series of tax adjustments. The first category of tax adjustment are non-allowable expenses. And we start with the category of depreciation. Therefore, we add back the following. 1, depreciation. And we have depreciation for the following. Building. 2, plant and machinery. And 3, lease assets. Now, from the information given to us, we were told that the building cost 175, and this is the start of the year, and the policy is to depreciate it at 10% on straight line. 10% on the straight line means 100% divided by 10% give us 10 years, which means the useful life of the building is 10, which simply says 10% of 175 million. Or simply put 175 million divided by 10 years, which gives us 17.5 million per year. We are told that the balance in respect of plant and machinery is after providing for depreciation of 30 million. Therefore, we add back 30 million depreciation for plants. Now, if you go to the additional information 3, it says the assets held under finance lease was acquired during the year. The relevant tax law does not distinguish between finance lease and operating lease. Rental expense for lease is tax deductible. The annual lease rental is 72 million and was paid on 31st December 2017. The depreciation policy for lease asset is 20% on a straight line, while annual finance charge is 36,667,000 naira. Therefore, the question then is, what is the depreciation charge for the lease assets? First, we are given the balance after depreciation of 200,000 as the asset under lease. And we are given information that the lease asset has 20% as the depreciation rate. If you go by that information, it means 20% depreciation on the straight line is equivalent to 5 years useful life. That is 100% divided by 20% will give you 5 years. Which that means that if out of 5 years, 1 year has been depreciated and the balance remains at 20, therefore, what is the depreciation for each year? There are 2 ways you could do it. You could attempt solving it by saying 200 million is the amount available for the remaining 4 years. We simply put that the depreciation per year is 50 million, which means if you say per year is 50 million, it means 50 million times 5 years will give you 250 million as the value of the leased assets at the inception. Okay, alternative to that is to gross up. If you gross up 200 million by 80%, it gives you 250 million. Now subtract 200 million from 250, it gives you that same 50 million. And that is that for us to understand. Okay, and we borrow the principle of IAS 16 with respect to depreciation computation. That's how we are able to arrive at this answer. Now the next one, apart from this, as deductible item, is that the interest recognized on the lease will also be disallowed. Why? Because in the note 3, we are told that only the actual rent is allowed. Therefore, the accounting charge such as depreciation charge is not allowed, and likewise, interest charge or annual finance charge is not allowed. Therefore, the annual finance charge is equally disallowed because it is replaced with the 72 million annual lease rental. Therefore, we add back 36,667. Okay, interest expense is allowed only on a cash basis. But if you go by the information given to us, in the balance sheet, we add interest. Okay, in the balance sheet, okay, it's already aggregated along with the account receivable and payable. Okay, let me check, where's the information? Yeah, in the receivable, we have interest receivable of 2.5 million. Now, in this regard, we are also giving information that there were no opening balance with respect to this interest receivable. Now, what it then means is that such an interest that we have accounted for as an income in that year will not be subjected to tax in that year because it has not yet been received. Remember, anything receivable means it has not yet been received in cash, which then means that such income is non-taxable. When we get to that category, we'll more or less look at that. The other aspect is interest payable. Interest payable means you have accrued for interest and it has not been paid. And from this position, we are told that interest payable is only allowed on a cash, interest expense is only allowed on a cash basis, which then means that since it's not yet paid for, it is disallowed, it's added back. Accrued interest expense. You add it back, how much is that? That is 8,250,000 naira. What other item is disallowed based on the information made available? Also, fines. We are told that fines and penalty from this question are not allowable for deduction for tax purposes. And how much is the fine? The fine is 25 million. Fines and penalties, 25. Okay, also, in the question, it says, the receivable note 4 figure is shown net of allowance for doubtful debts of 17.5, which means the receivable is after they've deducted 17.5 million as provision for bad debt in the first year. A deduction for debt is only allowed for tax purposes when the debtor enters liquidation. And remember, when you make provision, it's not a specific bad debt. Therefore, it's not allowed for tax purposes. In that case, what do? We add back provision for doubtful debts. How much is that? 17,500. These are add back items. Can somebody sum them up? Can we sum them up? 17,500 plus 30,000 plus 50,000 plus 3667 plus 8250 plus 25,000 plus 17,500. If I'm right, that should give me
184,917.
917. Okay. Now, what are the things to be deducted? First, remember we talked about non-taxable income, which is the interest income. It's not taxable because it has not yet been collected in cash. It's only accrued for. And we are told that the interest income will only be taxed on a cash what? Basis. And since it's receivable, it has not been received. How much is that? That's 2,500. Okay. What a lease rentals. Remember that we disallowed depreciation on the lease and disallowed finance charge on the lease, but it will be what will now be allowed in lieu of those two items is the lease rentals. Annual lease what? Rentals. I remember the annual lease rental was 72 million, all figure in thousands. And that is that. When we add these two together, the deductible item is 74,500. That should give us our adjusted profit. Adjusted profit. Okay, what's our adjusted profit? It's our accounting profit, 55,000 plus add back items, 184,917 minus deductible items, 74,500. That should give me 335,417. Now, what will I deduct? I now deduct capital allowance. Now, I have two items in which I'll deduct capital allowance. The first one is the building. Remember, we disallowed the depreciation for building. We'll now take as a surrogate, we allow the capital allowance. And information about the capital allowance for building was 105,000. And we all know the reason why it can be as so high as that in year one is because they will have charged both initial allowance and probably the annual allowance. And for plant and machinery, the information provided about capital allowance is 25,000. What do you have? The 2 is 130. All things being equal, our taxable profit is how much? 335,417 minus 130. That should give us 205,417. And we thereby apply the tax rates. What is the tax rate? 30%. Therefore, what's our current tax? Current tax is Roman figure 1 multiplied by Roman figure 2. And that is how much? 61,625. Okay. That is that. Any question on this? Any question on this?
Yes, Mr. Moyo. Just a quick one. Can you hear me?
Yeah.
Okay. The lease rentals, they said the annual lease rental is 72 million and was paid.
Yes.
On 31st December. Isn't that a deduction before arriving at the accounting profit?
Okay, if you remember that in a finance lease, you don't deduct the lease rental in your profit or loss. What you deduct is depreciation of the leased assets and you deduct interest on the lease obligation. Those two are surrogates for the lease rentals. Whereas it's in the operating lease that you deduct lease rentals because there's no asset to be depreciated and there's no lease obligation recognized ab initio. Are you getting what I'm saying now?
Yes, continue.
Yeah, that is the reason why.
Okay.
That's why tax is now saying that I don't go with what IS 17, your old standard, says. My own is that when you lease, treat lease like normal rent. Forget all this, you're discounting your future value to present value, depreciate it, unwind the discount, all those ones. I don't understand from tax perspective. Tax says, how much is the amount you are paying each year for the lease? That is what I will allow as deduction. Any other thing you have done, disallow it. Now allow what the lease renter is. Simple. And that's what we have done.
Okay, thank you.
Any other question? We have only attempted solving the A part of the question. The B, which carries the highest mark, says calculate the deferred tax liability as at the end of the year. Now, what do we need to do? What we need to do is to do the following. B. Deferred tax. Now, it's a single year. 2017. Now, what should I do? I can have each class of item. Class of item. Let me look at the elements of the financial statement. Now, what are the items that are in the balance sheet? I'll pick them one by one. Items in the balance sheet. We have building. I have building. I have plant and machinery. I have leases. I'll combine the lease asset and lease liability together. I have trade receivable. I have interest receivable. Sorry, I think I've crossed that borderline. Interest receivable. I have fines payable.
Evans.
Fines payable. I have interest payable. What again do I have? Building, plant, assets, fines. Okay, that is all. Now, let us now identify which element do they belong to. Now, building, is it an asset or a liability? Building is an asset.
Assets.
Plant and machinery is an asset. Abi? The lease, is it an asset or a liability?
Yes.
Now, we need to compare the kind amount of the lease asset with the lease obligation. If you check your balance sheet, the asset under finance lease was 200 carrying amount, Abi? Why the lease obligation is 260? Which means if you net it up, I'll put it now, net is net of a liability. Is that right? Net of liability, Abi? 16. Okay, trade receivable. Trade receivable is an asset. Interest receivable is an asset. Fine payable is a liability. And interest payable is what? A liability. Now, what do we need? We need the carrying amount. Or figure in thousands. Now, what is the carrying amount of building? It's already given to us as 157,500. How do you arrive at it? Remember, the cost is 175,000 minus 17,500. That gives you 157, which is also given to us, ready-made. Plant and machinery is 250, ready-made. Lease, when we net it, is 16. Trade receivable is 182,500. Interest receivable is 2,500. Fines payable is 25,000. Interest payable is 8,250. Now let us compare it with the tax base. Now, what is the tax base of the building? Tax base of the building. Tax base of the building is simply the cost. What was the cost of the building? 175, Abby?
75.
The capital what? Allowance. What was the capital allowance of the building? It was 105. Can we remember? It was what? 105. Remember here, 105. What was the capital allowance here? 105. Can you see it here?
Yes, yes, it is.
Yes.
Can you see it here? Okay.
Yes.
And capital allowance for plant and machinery is 25,000. Okay.
Less 105. 70. 25.
105.
Yes.
That give me how much? That give me 60.
7.
70.
Is it 70?
70.
70. That gives me 70. Okay. I come up here and say 70. What is the tax base of plant and machinery? What is the cost of plant and machinery? What's the cost of plant and machinery? Who can attend that? Go back to the question. What is the cost? Remember, they gave us the book value to be 250, Abi?
Yes.
And we are told that it's after he has deducted depreciation of what? 30. Which means the cost is what? 280. Now, less capital allowance.
Of 25.
Of 25.
Mm.
What do we have? 255. I'll come here. 255. Okay, what next? What next is finance lease? Now, remember that the recognition principle we had under IFRS, that's under IS 17, which was the old standard, for lease is not recognized in any instance for tax purposes. Which then means that in that case, the tax base of such a liability does not exist, which means the tax base of the net lease obligation is nil. Is what? Nil. Why? Because the tax law does not recognize such a measurement. It only recognizes the actual lease rental that was paid as an expense. Therefore, there's nothing like a liability to be recognized because the lease for that year has been paid by you. Therefore, which liability are you talking about? And that is the position of the tax. Therefore, this is zero. Trade receivable. Now, remember, the tax law says, why are you deducting provision from your profit? You said it's a doubtful debt. But the law says no. You still have the ability to collect it. It is only when the company ceases to operate, which means upon liquidation, that is only when we can deem it that it is a bad debt. Which then implies that to determine the kind amount, the tax base of trade receivable, you need to determine what is the kind amount, what is the kind amount of receivable? It was one what? The kind amount?
182,500.
182,500. Now, it won't have been 182,500 if you have not deducted provision, Abi?
Yes.
Which means what do? You add back that provision, which means if you have not deducted that provision for doubtful debt, your receivable should have been
200.
200. That is the tax base. Therefore, I come here and say 200. Now, interest receivable. There is nothing like interest receivable because for tax purposes, that interest has not been received. Therefore, what you need to do is that for tax purposes, the tax base of such an interest receivable, given that it's only going to be recognized for tax purposes on a cash basis, is nil. What that means that in that case, we come here and say zero. Now, this knowledge of this tax base is where we are going to close out with, which I told you yesterday, that we'll discuss how do we define tax base specifically for assets and for liabilities. Now, what is the tax base for interest payable? Similarly, the tax base for interest payable is equally going to be treated in similar manner with the interest receivable because the law says it's on cash basis. This is also what? Nil. And therefore I come here, I say this is what? Nil. Now, what is the tax base for my fine? The tax base for fines and penalty is equal to the carrying amount of how much? 25 million. Now, what does that signify? Because the law says that fines and penalty will never and ever be allowed for tax purposes. It means such a difference is a permanent difference. And remember, permanent difference does not result in temporary difference because they are two different things. Which means even though there is a difference between the kind amount and the tax rate, but that difference seems to be permanent. In that situation, where the liability or an asset does not have a tax consequence, which means it's not going to be allowed whether today, tomorrow, or next year for tax purposes. Such assets or liabilities will always have their tax base equal to the kind amount. And we're going to see it in the definition of the tax base of an asset and liability, which means invariably here, because there won't be temporary difference, the only reason why there won't be temporary difference is when the tax base and the kind amount are the same. And they are the same because there's no temporary difference. Rather, the difference that exists is a permanent difference. The next thing is to recognize our temporary differences. Now, this temporary difference, we have to be careful. Remember this matrix, deferred tax matrix. Asset and liability. Where kind amount is greater than tax base, and where kind amount is less than what? Tax base. We said this is taxable, temporary difference. This is what? Deductible, temporary difference. This is what? Deductible, temporary difference. And this what? Taxable, temporary what? Difference. Now, the first thing is for us to find the differences. Now, the difference here is how much? 157,500 minus 70,000.
7,500.
How much is it? 87,500.
7,500.
Okay, 87,500. Is it taxable or deductible?
Taxable.
Taxable. Because the kind amount of an asset is greater than the tax base.
Tax base.
But in the second one, plant and machinery, the kind amount is less.
Yes, yes.
Therefore, that is not what? It's not taxable. It is what? Deductible. Therefore, let me change this sign. This is what? Deductible. Of how much?
5,000.
Okay. Let me just put the key here. The key is positive is taxable and negative is what? Deductible. Let's take notes. Okay. Now for lease, the kind amount of liability is greater than the tax base. Is it taxable or deductible? Let us come back to our matrix. Liability, this liability, the kind amount is greater than tax base, therefore it is deductible. Can you see it here? Yeah. Therefore, I come here, that's another deductible
17,500
of 16,000. Now, for assets, here again, for trade receivable, the kind amount is less than the tax base. It's also deductible of 17,500.
Right.
Now, for interest receivable and asset, the kind amount is greater than tax base. Therefore, that is what? That is taxable. How much? 2,500. Okay. For fines and penalty, no difference. And for interest payable, the liability kind amount is greater. That is another what? Deductible. Of how much? 8,250. Now, what is our tax rate? Our tax rate, our tax rate is what? 30%.
30%.
30% across all. Therefore, what is my deferred tax?
11,250.
My deferred tax, the one that is taxable, which is in red, positive red, will give me deferred tax liability. Is that not? 30% times 87,500 That'll give me what? That'll give me 26. 250.
250.
Let me also do 25 times 30. Let me do the liability first. That's 750.
750. Yes.
And this is 0. Okay. Now let me do the assets. 5,000 times 30. What do you have? 15. 16,000 times 30. What do you have? 48. 17,500 times 30. What do you have? 5,250. 8250 times 30%. That's 2475. Okay. Can we sum up everything? 26,250 minus 1,500 minus 4,800 minus 5,250 plus 750 plus 0 minus 2,475. That gives us what? 12,975. Is that correct? Okay. That gives us
12,975, yes.
Now remember, let me put the signs there vividly for us. Remember, this is a liability. This is what? A liability. Or let me put it, deferred tax liability, deferred tax liability. This is deferred tax assets. Deferred tax assets. Deferred tax assets. Deferred tax assets. Okay, which means net. What do we have? The net position is deferred tax liability. The net position is what? Deferred tax liability. Let me write it clearly. It's not showing clearly.
Why?
This is not applicable. Net. Deferred tax liability. Now, this 12 is the same thing as, what is the sum of this? Can we sum up this? Since the tax rate remains the same, 87,500 minus 5,000 minus 16,000 minus 17,500 plus 25 and minus 8250 gives me 43,325, which means the net is net taxable. When you now multiply this by 30%, what do you get? You still get the same thing as 12,975, which means you can use any approach. And the reason why I'm showing you this is that in examination, the time may not be your friend. And if the time is not your friend, what do? You try to be smart so that you get the same thing by using simple analysis or shortcuts. Okay, and that is the position here. Which then means that our deferred tax liability, according to the question, is how much? It's 12,975. Okay? Now, but that is our deferred tax liability as at the end of the year. That's our deferred tax liability as at the end of the year. Okay. Now, let us now check the movement in deferred tax liability. Were we given any opening balance?
No.
Movement in deferred tax liability, in net deferred tax liability. As at 31st December 2017. What is our opening balance? Opening balance of deferred tax liability is 0. Why is it 0? Remember, this company just started business on January 1st, 2017. Okay. If you read the question says the building was acquired that year. Everything about it is the start of that year, presumably. Okay. And as at the end of the year, what is our closing balance? Our closing balance was 19, no, is it 19? Was 12,975. 12,975. $12,975. Now, what is the movement? Is it a decrease or an increase?
Increase.
It's an increase, Abi? Therefore, an increase.
Yes.
An increase. An increase in deferred tax liability is what? Recognition of deferred tax what? Charge or expense. How much is it? 12,975 what? 5. Now, C question says, the C says what? We should show what is our income tax, Abi? Prepare a note showing component of income tax. I'll just come here.
Expense for the year.
Yeah.
Tax expense.
I'll say the components of the income tax expense for the year ended 31st December 2017 are as follows. Remember, I don't use abbreviation. 1, current tax expense of, how much is our current tax expense again? 61,625. In millions. And 2, deferred tax charge of 12,975. Hence, the amount of income tax expense to be recognized in profit or loss is, what is the total of the two? 61,625, have you? Everything sum up to 74,600,000 naira. Does that make sense?
Lot of sense.
Does that make sense?
Yes, sir.
Reasonable.
Any other question?
Okay, sir.
my question. I just scroll down your screen, sir.
I should do what?
Scroll down your screen, sir. The question I want to
Okay,
ask.
I'll do that. Okay, I'll do that, sir.
Is that deferred tax table?
Okay, I'm coming.
No, yes, sir. The calculation that we did.
Which of the calculation?
Almost there, almost there. Okay. Okay. Yes, sir. Okay.
I think we are there.
Yes, sir. Okay, I understand that to get temporary difference, it is kind amount minus tax base.
Okay.
Now for leases, is it that the tax equation is kind of turned the other way? Because for
I didn't get you.
Now, okay, for building, which is an asset, the carry amount, the temporary difference is 87,500, which is 87,500 minus 70.
Okay.
Now, for leases, which is a liability, we are recognizing, a deferred tax asset. So to me, it's like that particular equation is turned the other way, like tax base minus carrying amount in case of a liability. Is it like that, sir?
Okay, sir. What we are interested in is there are two what's it called? There are two forms of temporary difference, which is what I'm doing here: deductible and taxable. If you go back to this my deferred tax matrix, the question is, when you have an asset, anytime the kind amount is greater than tax base, we say it is taxable. Abi?
Yes.
Anytime the kind amount is less, which is negative, we say it is what? Deductible.
Deduct.
And this two is for what? Asset. Abi?
Yes.
Is it not?
Yes.
Now, for a liability, anytime the kind amount is greater than tax base, which means it is deductible, negative. Anytime the kind amount is less, because I've told you before that asset and liability are like opposite. It will be what? Positive. Yeah, and it is what? Taxable. And that is the methodology we have adopted. Is that clear?
Yes, very clear, sir. Clear,
Yeah,
sir. Thank you.
that's it.
Yeah, thank you, sir.
That's methodology we have adopted.
Right.
Okay, there are different ways you can do it. But what matters is that the principle remains the same.
Yeah.
Any other question? Any other question or contribution? Okay, to wrap it up, let us go back to our material. First, this is a question before you guys. The question is this, which is question 6. Question 6 says, describe the tax basis of assets and liabilities in accordance with IAS 12. And B says, what is the tax base of the following transactions, assets and liabilities as scheduled below? Now, the first question is, what is the tax base of an asset? And what is the tax base of a liability? Now, let's go back to our presentation slide.
Carrying amounts less temporary difference.
No?
Yes.
We'll get there. Okay. Okay, let's start with an asset. Now, what is tax base of an asset? The tax base of an asset is equal to the amount that will be deductible for tax purposes against taxable economic benefit that is expected to flow from the use of that asset by the enterprise. Which means when you have an asset, at every year end, the tax base of that asset should be equal to the amount expected to be enjoyed by way of tax deduction against your profits in the future. And that's why you find out that for items that are qualifying capital expenditure, such as PPE, it is easier to determine their tax because if it costs me 10 million naira, and in year one, I've only enjoyed capital allowance of 2 million, it means what portion of the 10 million naira I'm yet to enjoy, which I will enjoy in future years, is the 10 million minus 2 million already enjoyed. Which means what is left to be enjoyed for tax deduction in the future is 8 million. And that's what we are saying. And what is the further consequence of this? The further consequence is that when the economic benefit to which the asset is associated is not taxable or is totally exempted from tax, it then means that there is no temporary difference that could arise from such a transaction. And for there not to be temporary difference, the only factor that will have occurred is that the carrying amount of an asset and the tax fees are the same, which invariably means that we can deduce the fact that provided the economic benefit associated with an asset is not taxable, therefore, the tax base at every instance must be equal to the carrying amount. And that is similar to the principle we adopted for that, for an asset. Whenever we have an asset where it will not be, where the income will not be taxable, at every point in time, you must ensure that the amount of his tax base will always be the same with the carrying amount. Now, that leads us to simple examples, which I can just briefly show you, and that will assist you guys to solve the main question that I gave to you in your practice question. Now, this first question says, a plant costs 20,000 naira. For tax purposes, depreciation of 5,000 has already been deducted. They say for tax purposes, depreciation has been deducted. It means this is a tax deposition, not accounting deposition, which means this is a capital allowance. Now, we are now told that revenue generated using this plan is taxable, which then means that there's a tax consequence to this. In that case, what will be the tax base? The tax base will simply be from the cost of 20,000. I've already enjoyed 5,000 as capital allowance. What is left for me to be enjoyed in future is the difference between 20,000 and 5,000, which is 15,000 naira. Also, we have interest receivable having a kind amount of 3,000 naira. But the law says that any interest revenue related to it will be taxed on a cash basis, similar to the question we just saw. If the law says that revenue will be taxed on a cash basis, whereas you have only accrued for it, such does not have a tax base, which was the conclusion I read there. And that's the same conclusion we are confirming here. Similarly, you have a trade receivable that has a kind amount of 25,000. Recognizing trade receivable means you have recognized revenue from sale of goods. And what does the law say in this regard? The law says the related revenue has already been included in the taxable profit. For anything to be included in taxable profit means it has been allowed whether as taxable income or allowed as deductible expense. Which then means that in that situation, the requirement of the tax law is in tandem. It's similar in treatment with what financial reporting requires. In that case, there won't be tax temporary difference. And the only time temporary difference will not exist is because the kind amount and tax base are the same. In that regard, I can infer that my tax base is the same as that 25,000, which is the kind amount. Also, let's look at this regard. If you have a loan receivable in your book, it means you are the lender of money. Now, you lent out 10 million to someone, and we are told that anytime you are repaid the value of your loan, there's no tax consequence on the value of the loan. We are not talking of interest, on the value of the loan, which then means that it means the economic benefit that flows from the repayment of that loan is not taxable. And we are not saying that any asset to which the economic benefit is not taxable has no tax consequence. And in that regard, it means there's no taxable, there's no temporary difference. And there's no temporary difference because the kind amount and the tax rates are the same. Invariably now, I can deduce that the tax base is equal to the kind amount of 10 million. Lastly, we are told here that we have dividend receivable from a subsidiary. What does that mean? Dividend receivable is an income recognized from your investment in another entity. And we are told that the kind amount is 50,000. But the law says dividend is not taxable, which means there's no tax consequence from it. That cannot result in deferred tax. And it can result in deferred tax because temporary difference is zero. And temporary difference can only be nil if the tax base and the kind amount are the same. Invariably, what then happens is that we need to now recognize our tax base of such a dividend to be 50,000. Now, but slightly, the definition of liability is different. The first point of reference for determining the tax base of a liability is the kind amount of that liability. But it is the kind amount of that liability subject to an adjustment. And what is the adjustment? You adjust for any portion of the kind amount of that liability that will be allowed for future deduction against taxable profits of that entity. Which then means that the tax base of a liability is the kind amount of that liability less amount that will be deducted against the taxable profit of the company in the future. Now, what can you conclude as one of the consequences of this? A situation where revenue has been received in advance and such revenue has been taxed on a cash basis. The conclusion then is that the tax base of such a liability, remember, when you receive income in advance, it's a liability. Such liability, the tax base will be the kind amount of that liability less amount of revenue that will not be deducted for tax in the future, or because you have taxed it last year when I didn't recognize as income, or because you have claimed that I've received it. Therefore, you taxed it when it was received. The subsequent year, when I'm now recognizing it as an income, it can't suffer tax the second time, or because it is going to be exempted in this year, or because it has been subjected to tax in the earlier year. And that's what we are trying to explain. Now, let's look at a practical example. Now, we have a current liability. In this case, the current liability is an accrued expenses. And we are told that the current amount is 12,000. But the related expenses will be deducted for tax purposes on a cash basis. What it simply means is similar to the interest payable in the examination question we solved, where there is no tax consequence for something. In that case, the tax base is nil, straightforward. Secondly, you have interest revenue received in advance, which is a liability in this case. The kind amount of it is 14,000 naira. Now we are told that the related interest revenue has been subjected to tax on a cash basis. It's similar to the first question, the first illustration. There's no tax consequence on it, and therefore the tax base is nil. But a situation where the accrued expenses is 1,000, and for tax purposes, such accrual is equally allowed as a deduction. It means there's no temporary difference, or because the kind amount of tax base are the same. From there, we can conclude that our tax base is 1,000 as an accrued expense. Also, accrued fine and penalty of 5,000 naira, and we are told that neither would fine nor penalty be deductible for tax purposes. In that situation, what then happens? It means it results in a permanent difference. There is no deferred tax implication. And there's no deferred tax implication because the taxable or the temporary difference is nil. And it's only nil because the kind amount equals the tax base. And in this case, the tax base will be derived from the kind amount of 5,000 naira. Finally, you borrowed money. You now have what we call a loan repayable with a kind amount of 30 million. When you repay the principal amount of loan, it's not deductible, it's not taxable, which means it has no tax consequence. And remember, anything that has no tax consequence will always have the kind amount and the tax base to be the same. Invariably, I can conclude that the tax base in this case is 13 million naira. And that is that. On that basis, you have this practice question to solve. Now, I'll give you just 5 minutes to think about this. And in 5 minutes, you just give me your answer for 1, 2, 3, 4, 5, to 8. Okay? Eh? What do you say? This is 1, 2, 3, 4, 5, 6, 7, and what? 8. Okay, I'll give you 5 minutes to do that. 5 minutes. Okay, we are welcome back. We are welcome back. Can we answer that question? Who will volunteer to answer the question? Who will volunteer? Who will volunteer? Who will volunteer to answer the question?
Question 2.
Question 2 or question 6?
Question 2.
Yeah. Question 2, in what sense? We are solving question 6.
6-2.
No, what I mean is I want to start with question out of the 8. I want to start from number 2.
No, start from number 1.
I didn't get the number 1.
Number 1 is 15,000 tax base.
That number 1 is exactly the example we looked at. How come you didn't get the same question? Nothing changed.
$15,000.
Is how much? 15,000?
Yes.
Okay, I think that is right. $15,000. Okay. Oh yeah, the man I want to start with question 2.
Question 2, 3,000.
Correct.
Are you sure? The interest is
Yeah.
no. Of 3,000.
No, sorry. Question, no, sorry. Question 2, nil. Question 2, nil.
Question 2 is what? Nil or 0?
Nil.
Question
0.
3?
Question 3. 25,000.
Okay.
Yes.
Question 4.
10 million.
10 million.
10 million.
Yes.
Yeah. Question 5.
Nil.
Question 5 is what?
Nil.
Nil. Is that correct? Yeah.
I didn't get it.
The same principle that affects question 5 is the same principle that affects question 2. Okay.
Okay.
Question 6.
Question 6, nil.
Nil. Question 7.
1,000.
And question 8.
5,000.
1,000. Question 6 is 14. Okay. I failed it. I put 14.
Because questions 5 and 6 are the same. Because of the principle of cash what?
In advance. Okay.
Okay. Now, if you go to your chart, go to your chart mode. I've dropped, for those that don't have the question, once again, I've dropped the question on the chart. I've dropped the, that's the practice question, the material, presentation material, and also the solution that we did from Sunday to date. I've also converted it on PDF and I've sent it. Have you all seen it?
Yes.
Do you all see it?
I
In
saw
the
it.
chat. What about others? Others, did you see it? Dare Alabi, did you see it?
No, I didn't check, sir.
Check your chat. I think I
You posted
check.
the one of 11 p.m. yesterday.
No. I'm
On
talking
the
of
group chat.
not group chat, on this chat, on this Zoom chat now.
Okay. Okay.
Check on Zoom chat.
I can see a file.
You can see a file. 3 files. Is it 3 files?
Is it
Let me send it. I think I wrongly sent it privately. Let me also check again.
put it down for me? Thank you.
3 files.
Have you seen it?
Okay, I can see it now.
Okay.
It just came in now.
I think I was sending it privately before.
Oh, okay. Okay, you said both PDF and Excel.
Yeah. There are 4 things I've sent now, but 3 has dropped. One will drop in the next 2 minutes. Okay, let's close it up with this discussion. Technically, we are at the end of the session. It's just to make reference to 1 or 2 things in the material. Okay. I think we've looked at virtually everything. The only other aspect I wanted to look at is limitation of recognition of deferred tax assets. Okay. Okay, now this is the last one to look at. Exception for the recognition of deferred tax assets. Okay, there are 2 circumstances in which IS 12 does not apply, which means you cannot recognize deferred tax assets or liabilities. Now, the first instance is that you can only recognize deferred tax asset on goodwill. That is on initial recognition of goodwill, but you cannot recognize deferred tax liability. I will have taken you through a practical process of that, okay? But that is for professional level. That is for corporate reporting. And when you check my practice question, I think I included it there, but that is solely for the purpose of people in corporate reporting, where we need to now look at effect of deferred tax in a business combination. I remember goodwill only arose from a business combination. Okay, I think, okay, it's not even in this one because this is purely for skills level. Now, question 14, I can advise you to go and play with it. It's so interesting. And I won't tell you what you'll find out there, but if you are willing to explore, you can check that question 14. Okay, let's go back. Deferred tax liability is not recognized upon initial recognition of goodwill in a business combination. And likewise, deferred tax liability or asset will not be recognized on initial recognition of an asset or liability, except if it arose from business combination, that is one, and if the effects does not have, it neither affect accounting profit nor taxable profit, which means whenever you have deferred tax liability or asset, you don't recognize them when it emanated from differences that originate upon initial recognition of asset or liabilities, because such difference is deemed to be permanent difference. Okay, but exception to that fact is that if it arose from business combination other than initial recognition of goodwill, such will be recognized. And finally, when we have deferred tax assets, not necessarily that the amount of deferred tax asset computed will be recognized. Okay, because when we talk about assets, we need to be very careful in the recognition, similar to what we call the Prudence Principle. What it simply implies is that anything you recognize as an asset should be what is recoverable with respect to economic benefit. Or like liability, it's more probable that your liability have to be settled than more probable for your asset to be recovered. Which then means that in that case, similar to what we do to other assets by subjecting them to impairment, similar thing happens here, but it's not about impairment. It's about the limits to which you can recognize deferred tax asset. Which means if my computation of deferred tax asset is 10 million, I might not be able to recognize 10 million in that year. Why? Because from recoverability tests I've carried out, or what we call asset ceiling tests I've carried out, it might reveal to me that of that 10 million, only 8 million can be recovered from future taxable profits. In that case, I won't recognize 10 million. I'll only recognize 8 million. And the unrecognized portion of deferred tax asset of 2 million will be disclosed in the financial statements. And the reason for not recognizing it will also be disclosed. And in future period, there is a probability or possibility that your condition can improve so that you can recover it. You can now recognize it and bring it onto the books. And that is the position of IAS 12. Okay, and finally, in IAS 12, you are required to reconcile the actual taxes, which is your current tax, to your income tax. And there are two approaches of doing that. It's either you adopt relative approach by reconciling the effective tax rates to your corporate tax rates, or you do it in absolute terms by reconciling your tax based on accounting profits to your current taxes. And let me show you an example from MTN annual financial statements. MTN annual financial statement in this regard, in the disclosure of information, the income tax is on note. Let me try and check the notes. Income tax is on note 3.1. And you see how the reconciliation is done. And MTN adopted I think the absolute reconciliation presentation. Okay, and that's the most common one. But relative is also acceptable to the standard. Okay, can we all see it? Let me expand it. Okay, I think they did the absolute and I think they did the two together. Okay, let me check. Okay, they did the two together. The first one is the absolute, reconciling their income tax to their current tax. Okay, the difference between the normal tax and the income tax for the year is what is being shown here. But the relative reconciliation is in percentages. Okay, in that case, what we have is we reconcile the corporate tax rates, which they call the statutory rates, which is 28%. We reconcile it with the effective tax rate, which is 36.18%. And what are the justification for it are all these items that result in the temporary difference, both temporary and permanent difference. And if you remember the case of MTN fine, you can see it here. Part of what's brought about those differences is the humongous fine that was given to MTN for breach of what's it called, security with respect to SIM registration. And it's disclosed in Nigeria regulatory fine and related expenses, got additional tax of about 2.16 and some other things. These are reconciliation, but this it's going to be much more discussed and practically it will be shown with illustration when you get to final, which is professional level, where a simple reconciliation will be done for you to have better understanding of it. And on that premise, I believe everyone has downloaded what I attach to your charts, okay? And on that basis, I think we brought the class to a close. If there's any other question, I'm free to answer. And if there's none, I think for now, we may call it a night or a day. Any other question?
I couldn't see the attachments.
What did you say?
I couldn't see the attachments.
No, it's there. Everybody has seen it. Go to the chat box.
Yeah, I'm there.
Yes, it's there. It's seen by everyone. Go to the chat box.
Mm-hmm. That chat box, you see the files there. Just download to your laptop.
I've sent you all the files before, but I'm just sending it for those that were requesting for it. Please. Okay. Have you seen it?
I didn't see it though.
Okay, probably you speak to some of your colleagues to send it to your WhatsApp. But again, I've already sent it to the conventional WhatsApps. Thank you very much, and God bless you.
Thank you very much, sir.
Thank you. We appreciate you.